Hello and welcome to the Opening the Gates H1 2026 UK property market update, where I am going to be reviewing the first 6 months of the year, comparing it to the first 6 months of 2025, the first 6 months of the last 5 or 6 years, and also the second half of 2025. Also going to be looking at June 26 data and comparing that to month on month to May, June of 25 and then 21-26 June average. And then as always, I'm going to be looking at mortgage approvals, transaction numbers, inflation, and then the house price indexes. So let's jump into it. Right, so to start with, as always, my opening the gates market update. So those of you who are new to the channel, from left to right, we've got year on year. Middle column is the first half of the year versus the previous half, which was the second half of 25. Then we've got the first half of 26 versus the 21 to 26 average. So on the market, properties for sale, you can see that a slight increase on the half year and versus last year at 2.5% and 2.10%, and up 20% on the 21-26 average. I don't know how many of these I've now recorded, but the continuing theme is stock levels are continuously at a dozen or so year high. More choice for buyers, which is great, but it means more competition for sellers. Therefore, it's going to keep prices intact. Why we're seeing properties take longer to sell and more price reductions, but I'll come on to that. New listings up 2.65% on the previous half, and up a whopping 24.35% on last year. Shows that sellers have not been deterred by some of the uncertainty. So in that 6 month period, obviously March, April, May was the conflict. Obviously going into June as well. And then June, we've had all the uncertainty around Starmer, his resignation, and obviously the Burnham by-election win. And then in terms of listing numbers across the average, 9.36% up. So healthy appetite for new sellers come to market, which is good to see. Sales agreed down 3.76% on last year, which I don't think is a bad result. It shows that with slightly higher interest rates across March, April, May, have now started to come down a little bit. It shows that that discretionary aspirational mover, you're going to find that somewhere between, I would say, low digits to 10% of the market drops off. But when you actually compare it to the second half of last year, it's almost 8% up, which shows that conditions are actually better than they were second half last year. Obviously, second half last year, we had the uncertainty around the autumn budget. We had the mansion tax, all sorts of tax things going on. So it just does show that things have actually moved in a better direction. The first couple of months of last year as well, if we're going to compare year on year, was obviously the stamp duty deadline, which meant that if you're comparing things to last year's first couple of months, it's always not going to look as good. But when you look through all the figures, there's always something we can be looking at as a positive or negative, which again, I'll come through in more detail. Sales agreed down 3.17% on the 21-26 average. So again, first half of 21, first half of 22, very buoyant. First half of 23, hangover from the mini budget. 24, pretty standard. 25, first quarter was pretty solid. So to be down 3.17%, I don't think is too bad. Price reductions up 1.2% year on year. 13% on the second half of 25, and then up a whopping almost 30% on 21-26 average. Price reductions continue to be crazy. There are almost 110,000 price reductions in the month of June, which again I'll come on to in some more detail. There are so many price reductions happening in the market, but the glass half empty is, well, there's too many agents overvaluing, there's sellers wanting too much money. The glass half full is sellers not withdrawing from the market, they're realigning their expectations, which is good to see. So withdrawn numbers are down 4.71% versus a year ago, down almost 16.5% on the second half of last year, and they are slightly up 8% on the 21-26 average. But withdrawal numbers are going in the right direction. Sellers are staying on the market longer, they're altering their prices, they're more committed, which is good to see. And in terms of commitment, fall through numbers down almost 9% year on year, almost 4% on the second half of 25, and just over 2% on 21-26 average. So there's going to be less fall throughs because less sales being agreed, but you can see that there are more buyers and sellers committed to the process, which is great to see. We obviously had in the month of June as well the home buying reform shake-up where they're talking about all sorts of different things from getting information ready earlier on, having binding agreements, which should hopefully mean that transactions will go through quicker and there will be less fall throughs. But that is into the future. That's not something that's going to be happening right now. Now, what I also want to show you is something where I normally have my notes on my other screen, but I'll share it today. So this is a June 2026 market information as well. So properties for sale, you can see significantly up on the June average. New listings actually up year on year. And on the 21-26 average, which you could see sales agreed down across the board, which is not unsurprising, coming out the end of the Middle East conflict, hopefully, or have seen the worst of it in terms of price of oil, rising interest rates. There was the uncertainty over Starmer, World Cup started, heat wave, etc., etc. Now, I did post a video on social saying Prime Minister changes, heat waves, and World Cups is a load of bollocks for agents to use it as an excuse. Whilst I do stand by that statement, you are going to get some hesitancy in the market because of those things. Price changes up across the board, 40% more than the 21-26 average. But as you can see, as I said on the first half year, withdrawal numbers down significantly, showing that sellers are committed in the market, which is good to see. And then fall through slightly up month on month, but barely, but down on the year on year and 21-26 average. So moving on to prices. So average asking price of a new listing last year was 435.5. Then second half last year was down at 412. You normally see asking price on new listings a little bit more competitive in the second half of the year, and then pretty much exactly where they were a year ago at 435 right now. And then average pounds per square foot was at 383 a year ago, 382 across the autumn winter months typically, and then 393 is where the first half of 26 has ended. Now, in terms of those numbers, average asking price new listing down 0.02% on a year ago, 5.5% up on the half year. Sales agreed up modestly on the half year, almost 1%, and then 0.26% on a year ago. And then new listing pounds per square foot, almost 3% up on the second half of the last year, 2.61% year on year. And then sales agreed pound per square foot, almost 1.5% on the last half of 25, and then 1.75% up year on year. So you can see pretty modest there in terms of house price growth across H1. Where we go back here. So you can see here sales agreed at 361.5, crept down a little bit to 359 second half last year, and then sits at 362.5 now. So prices have remained very, very solid. Properties priced correctly, low supply, high demand, they're still achieving prices. You've then got things like flats that are overpopulated in the market, low demand for them, their prices are being slashed. Sales agreed pounds square foot, so sits at 348 now, was 342 a year ago, in the second half of 25 at 343. So just going to whiz back through on the June side of things, year on year, average new asking price up just 0.33%, down 3.2% on new listings month on month, which Rightmove I think kind of reported as well. Sales agreed average asking price up just over 1%, and on the month, and then year on year almost 2%. New listing pounds square foot down 1% month on month, up 1.54% year on year. And then sales agreed pounds square foot up 0.57% month on month, and then 3.5% year on year, showing that prices are okay. We do not have the forced seller environment that we would have done in 07, 08 when interest rates, when we had negative equity and the market crashing. We're seeing maybe things get a bit slower to find these prices and maybe a little bit lower transaction volumes, but prices are holding firm. They are steady. Right, back to the update. 12-month net mortgage approval for house purchases. So if I go to my other screen, so May was 56,200 mortgage approvals. That was down on April. That was also down on last year and down on the 12-month average. I think it was the lowest number it had been since December 23, but I do think this is a hangover from increase in interest rates from the conflict in the Middle East. Don't think it's anything to panic about. If I just show this slide here, so down 14.7% month on month, year on year 10.8%, 12-month average of 11.1%, and then 10-year average down 4.5%. So not pretty reading, but it is just one month right now. Everything else has been going pretty smoothly in the 60,000s, and it'll be interesting to see where the next few months are on that. But I'm not worried by that. So done the 10-year net mortgage approvals, obviously skew whiffed in May 20 when we're just coming out of the first lockdown when the market reopened. I think what was that 9th of May or something. And you can obviously see mortgage approvals spiked in May 21 when the market was going berserk. But apart from that craziness in 21 and 20, you can see things normally sit at a pretty steady level there. Onto transaction numbers. So you've got 12-month property transaction number there and the 10-year here. And if I go to this, month for month, transactions down 2.6%, but still not far off 100,000. That leads us to around 1.1, 1.2 million transactions per year, which is not to be sniffed at. Year on year, things are up 16.6%. But again, that time last year was the hangover from the stamp duty deadline. But things are steady on the 12-month average, which is good to see. And then versus 10-year average up 6.5%. Of course, these transactions are completions in May. Those May completions would have got sale agreed probably at the back end of last year from properties that went on the market in Q3, Q4. So it's not highlighting the current interest rate environment, but it's still positive to see those transaction numbers because whilst we've got a higher interest rate environment now and the uncertainty over the Middle East, Keir Starmer resignation, we then had the autumn budget last year. We're just constantly going through these tough times and still coming out the other side, which is good to see. And then inflation was at 2.8%. I think it went under where the markets were predicting it to be. So inflation at 2.8%, not at the 2% target. I think there's still reports out there, but that still might creep up above 3% at some point this year for obvious reasons in the Middle East. But we'll wait and see on that. And then finally, the house price index updates. I think that this month has seen the return of home.co.uk. I think they take a bit of a break. Rightmove average asking price, very, very steady month on month and year on year. Obviously, that's on new listings. Zoopla at 272, slightly up on month and year on year. Land Registry at 270. Again, that is completed transactions, whereas Rightmove is looking at new listings, up 0.7% month on month and 3.8% annually. Nationwide, steady month on month, annually up 2.2%. Halifax almost at 299,000, a slight drop month on month at 0.1% down, and then 0.5% up annually. eServe at 327.5, 0.2% up monthly and 1.6% annually. And home.co.uk just shy of 366.5, up 0.4% monthly and 0.9% annually. So across the board, the average UK house price from the indexes I observed, so about half a dozen of them, which I think are the best ones to look at, currently sits at 312.5, up 0.11% monthly and 1.41% annually. So as I've kept saying for a long time, very, very small, modest house price growth across the market. And I take these different indicators because they're all looking at something slightly differently, from new listings to completions to mortgage valuation data to cash. Putting them all together gives us a good mix of what's actually happening in the market now, what has been, and what is perhaps to come, which is why I also look at the mortgage approval numbers, transaction numbers, and then go through all the indexes as well, which I'm about to. So on that note, let's move over to Rightmove. So Rightmove House Price Index, the latest one came out on the 15th of June. So prices dropped by 0.6% this month, their biggest June fall in 14 years. Number of homes for sale is down slightly on last year by 1%, but still at a historically high level. In terms of the Rightmove mortgage rates, I am actually just going to share a different screen quickly on this. It would help if I could type. Let's do that again. So really good link on the Rightmove website to check what they're reporting on interest rates. So take a picture of this at the top of the screen now. If I scroll down, the average 2-year and 5-year fixed rate reported by Rightmove and that's an average based on 95% market, has dropped below 5%. And that is the first time I've seen that for a while on Rightmove, and that's a real psychological factor. And hopefully, if those lowest ones can get a three in front of them, which we had before the conflict started in the Middle East, that will create more buyer confidence again. It will improve affordability a little bit as well. I think where interest rates are right now compared to when the conflict started, your average buying power has probably dropped by about 5%. So what that means is someone who was buying at 300 a few months back before the conflict, their budget would now be 285, or their monthly repayment is probably an extra £150 a month if they want to continue buying that property. Really good data to know when you're speaking to your marketplace. Right, anyway, back to Rightmove. The biggest June fall in 14 years as sellers look to entice some buyers, leaving prices 0.5% below a year ago. Summer typically is slower than the spring, more buyers attracted by sporting events, which we've got this year, holidays and better weather. Obviously, had the heat wave. Number of homes for sale remains at historically high levels this time of year. Driving price falls as competition attracts to attract a buyer remains fierce amongst sellers. So May's unusual heat wave kick started summer earlier than usual this year. We've obviously had that heat wave continue into June. Absolutely boiling, wasn't it, in 1 week? And then the World Cup may prove to be a distraction for home movers. Meanwhile, ongoing economic and political challenges and all this global uncertainty. So buyer demand across the month of May down 10%. However, their real-time data indicates that this was amplified by the unusual heat wave during a half-term week, which temporarily reduced some more activity level, move activity level, should I say. Number of new listed homes to market is down 5% compared with this time last year, but it's still 6% up on 24 and 12% up on 23, which is good to see. So despite those headwinds, sales activity remains steady overall, with sales agreed down just 6% year on year, but they're still broadly in line with recent years, virtually level with 24 and around 5% higher than 23. So what we see is in when the market has a bit of political economic uncertainty, or there's positives in place because of a base rate cut, swap rates going down, or is there going to be a Burnham bounce like we saw a Boris bounce, etc., etc. You see that there is normally somewhere around a 5 to 10% swing either way. And I would have said this probably in a previous one of these updates. 50 years of data shows us we do 1.2 million transactions. When we have wind behind us helping, we get to 1.5. When things are wind against, we go down more like to a million. And when shit really hits the fan, which we've not seen since 07, 08, we've hopefully learned our lessons from that. You get 750,000 transactions. Right. Scroll down here. I think that was everything I wanted to cover off. No, here we go. While June typically sees modest price increases with an average 0.1% average over the last 10 years, this month's decline suggests that many new sellers are adjusting their pricing expectations in response to high levels of competition and more price-sensitive buyers. That's nice to hear them say. Summer is typically slower than the spring, which we already touched on. More buyers are distracted by the sporting events, holidays, and better weather. This obviously we have Euros or World Cup every 2 years. This is going to be a busier summer. Obviously, we've got Wimbledon going on, Silverstone Grand Prix at the moment, and the weather has been extraordinarily good. So sellers, if they're wanting to sell, will have to do so with an attractive price. And then I just want to touch on this bit here. Number of homes for sale remains at historically high levels this time of year, driving price falls as competition to attract buyers remains fierce among sellers. In a market where choice is high and buyers are more selective, pricing correctly from the outset is increasingly important, with over a third of new listings that come to market not going on to sell. And Zoopla report similar sorts of data from the start of the year on that as well. So I think we've touched on all of these bits here. Yeah, so we're going to move on to Zoopla. I'm just going to take my drink whilst everyone wants to have a look at that. So Zoopla report 1.4% house price inflation, some modest growth there. Change in sales agreed versus a year ago down 7%. The average increase in monthly cost for a new purchase in London, £244 a month. You would have seen me speak about this before, but Ireland, Northern Ireland, Wales, Scotland, the north of the country are performing a lot better than South Southeast, Southwest, and London. It was a good LinkedIn post that Richard Donnell put out the other day in terms of where the market's at, and I have used that in my LinkedIn newsletter update, which you should go check out as well. If you're not already subscribed to that, subscribe to it so you get it in your emails every month. And if you're watching this on YouTube as well, please also make sure you're subscribed. So in terms of Richard Donnell, bottom left-hand side, he says it's a buyer's market across much of the south right now, but motivated sellers in Northern England and Scotland are still finding buyers at broadly last year's pace, which shows the housing market is not moving at one speed, two speed or two-tier market. Rightmove and Zoop have reported for quite a while. Mortgage rates peaked at 5% in April, having started the year closer to 4%, but they are now falling, which is good to see. And then down here, they expect price inflation to drift lower in the second half of the year. Sales agreed are on track to be 6 to 8% lower than last year. Obviously, the stamp duty deadline boosted that, and we're going to get about 1.1 million transactions, which is not to be sniffed at. That's still good. If I zoom in on this, really good data to look at here with sellers to highlight that we had the hangover from the mini budget and rates getting to 6%. The market rebounded as rates fell back towards 4%. Autumn budget speculation dampened activity, and then we had global pressures as well, and rates getting over 5% again, which hit demand and sales. But you can see here what's been happening recently is nowhere near as bad as the mini budget hangover. So scroll down here. It says sales down 7% as sellers adopt a wait and see approach. Buyer inquiries are 15% lower, which has been a consistent trend this year. The change of Prime Minister, what's that, the seventh in 10 years? Crazy. And the question over likely tax and spending priorities in the autumn budget has added uncertainty in recent weeks. And that's been reflected in other measures of consumer confidence. More buyers are taking a wait and see approach until the outlook becomes clearer. There's always a wait and see approach, right? Because there's always something going on nationally or internationally that potentially impacts the market. This is not the first time the market has absorbed economic and political uncertainty. The 22 mini budget triggered a far sharper fall in sales, and on previous occasions, the market recovered once mortgage rates stabilised and started moving lower, which I just touched on, and mortgage rates moving in the right direction, which is good to see. The Moneyfacts average mortgage rate at the time of recording, I think, is 5.46%, and that's the lowest it's been in over 3 months, which is positive to see. Before the conflict started, I think its lowest was 4.89, so it's still a little bit higher, sort of 0.5% there, but it's moving in the right direction, which is good to see. Although there's not much wiggle room, I think, from lenders in terms of where swap rates sit right now for them to adjust mortgages much more. So any buyers sat there waiting on lower mortgages, you might be waiting a little while. So average mortgage rates were less than 4% at the start of the year, peaked around 5% in April. As you can see from the paragraphs below, it increased monthly payment or reduced the buying power. But the positive, mortgage rates have already started to fall. They're edging lower and lower, which is good to see. And that decline in the borrowing costs does need to go further to improve affordability and support more sales in the second half of 2026. This is a very interesting part to look at. So higher mortgage costs explain why some markets are holding up and others are not. Sales agreed down 3 to 6% in Northern England and Scotland, where there are fewer homes for sale, and the cash increase in mortgage costs is smaller, but down more than 10% in Wales, South West, the East of England, and the East Midlands. So 2 and 3 bed houses are selling at close to last year's pace across most of the UK. Flats are the weakest segment, which you already know, with over 2/3 of 1 and 2 bed flats listed this year still unsold, which is mad. That's not a new trend, but it highlights the choice available to buyers and the importance of pricing homes to attract demand. The lower sale rate in the flats market is a first-time buyer story. The buyers most exposed to higher borrowing costs, and particularly in the capital. So stamp duty costs are around 3% of purchase price compared to less than 1% for a first-time buyer up in the north of England. So for any sellers been on the market since spring without an offer, the most important step is they need to speak to their agent and get their price adjusted. But mad here, looking at this image, again, really good one to be showing your market. So 59% of properties listed since the start of the year have not sold. So only 41% are going under offer, which is a similar figure to what Rightmove were reporting. So yeah, just let that sink in, because I don't think the public realise that only half the properties really come to market sale. Everyone thinks they've got an almost 100% chance. So you've got to get the pricing right, the marketing right, the agent right. If you get one of those things wrong, easily the difference between you not selling. You might have an amazing agent who's really good, right price, but bad marketing. It's not selling in this market. Have a great agent, great marketing, but the price is too high. You can't outmarket an overpriced listing. So you've got to get those three things spot on. And I think that touches on everything there. And then just a conclusion, sorry, and the outlook. So as we've already said, mortgage rates need to fall below 4.5% to improve affordability and bring more buyers back to the market this summer and into autumn. Obviously, selection of a new PM, probably Andy Burnham, as we know, and the autumn budget are going to be key moments that will influence buyer confidence beyond the pure affordability factors. Like I said earlier, politics to one side, maybe there will be a Burnham bounce. Like with you get your uncertainty before elections, and then afterwards things seem to go positively. It will just be history repeating itself. I put out an article, I think, in when the 24 election happened, showing usually you get a delay in the market because of uncertainty, and then you get a bounce afterwards. So sales agreed have weakened in recent weeks, but they're still broadly in line with 2025 through the spring. Sales in the second half of 22 are going to be suppressed by the speculation out there around the autumn budget, and the year-on-year comparison is likely to narrow through Q3 and Q4, even without significant recovery in buyer demand and sales. So at the start of the year, Zoopla expected they would be 2% below the high of 2025. The gap will be wider on the back of higher borrowing costs, reducing sales activity. So stock levels remain elevated, particularly in southern England, giving buyers plenty of choice and keeping price inflation in check. Pricing conversation with sellers remain very, very important, as getting the price right from the outset will define whether a home sells or not. I've got loads of data on that. If you're interested in finding out more about it, hit me up. And buyers are being very selective, but well-priced homes are selling quickly. One of my friends has just sold their property within a couple of weeks of coming to market at £1 million. Marketed well, good house, priced correctly, it's sold. So first-time buyer segment is the most rate sensitive, and they are being squeezed. And that's where any further rate falls will certainly help, and it will have an immediate impact on that demand and activity. Right, on to Nationwide. Quite a bit to go through in the Nationwide House Price Index this month because they like done a quarterly update. So annual change 2.2%, monthly 0.0%. So Robert Gardner at Nationwide has said prices broadly flat month on month after taking into account the seasonal effects. They're not surprised that the market softened a little in recent months given the uncertainty again caused by the developments in the Middle East and the subsequent rise in energy prices and then interest rates. Consumer confidence and measures of housing sentiment have also weakened, and we obviously saw that in the mortgage approval data that dropped noticeably in May. So we've got geopolitical, should I say, tensions remaining high. We've got the signing of a memorandum of the understanding between Iran and the US has helped push oil prices back towards levels before the conflict began. If the energy shock continues to subside, the Bank of England may not need to raise interest rates, or at least by less than had previously been anticipated. And that view has been reinforced by the fact UK inflation has also been lowered than expected in recent months. Recent weeks have seen a shift in the expectations from the market for the future path of bank rates. Has also helped bring down interest rates, which obviously underpin fixed rate mortgage pricing. So, if maintained, these trends will help to restore household confidence. Market so reacts on confidence, more so than actual numbers, real like psychological thing. And easing affordability constraints will pave the way for a recovery in housing market activity in the coming quarters, providing that the domestic political uncertainty does not adversely impact sentiment. There's some EPC data that I'm not going to run through on this, basically saying that EPC rated homes at A and B and C typically sell for more money than the lower rated ones. Don't think that's unsurprising. There is an actual EPC report that came out from Nationwide recently. You can literally click on this link and go see it. I'd recommend checking it out. You've then got some information here on how important is energy efficiency. Interestingly, and probably not unsurprisingly, it's more important the younger you are. So younger people are more interested in having better energy performance. And then if we look at the average mortgage payment on a typical first-time buyer property, um, in the UK, it's averaging 33%, which I'll show you in a second is, where is it? There we go. Right there on a 25-year average. So UK house price earning ratios, monthly repayment for first-time buyers is very much in check with the averages. We just go back to it. Um, This is such a mad stat. So a typical home in Northern Ireland is now around 80% of the average UK house price, up from 70% in Q1 24, but still well below the peak of 125% recorded in 2007. I just want to highlight that point because we've got so many different markets. Whilst I talk about the national picture, there's obviously different regions all performing very differently. And it's super important that you talk very specifically about your local market as well. Compare local nationally, that's the best thing to do. So many consumers will be reading the national headlines and will assume that's what's happening in their market. Make sure you're explaining social media, print marketing, email, in the living room, on video, what's actually happening in Newport Pagnell versus England and the UK as a whole. Right, on to Halifax. So average house price just shy of 299. Monthly change down 0.1%, down 0.2% quarterly, but still up 0.5% annually. So Amanda, head of mortgages at Halifax, has said average house prices remain broadly stable in May, with a slight fall of 0.1%, matching what was seen in April, with a typical property costing almost 299,000, while the pace of annual growth has edged up slightly at 0.5%. So she goes on to say property prices are trending to reflect the uncertainty linked to the developments in the Middle East. Despite recent cuts to mortgage rates, higher inflation expectations have kept borrowing costs above the level seen at the start of the year, and that's continued to stretch affordability for many buyers and temper demand. Even so, overall activity has actually held up pretty well, reflecting the underlying resilience, a word that probably comes up in every one of these recordings I do, of the UK housing market. And then the latest industry figures show transaction levels are remaining pretty stable, suggesting buyers and sellers are still moving, just maybe not at the pace they have done before. Amongst first-time buyers, annual growth is more subdued at 0.3%, while getting onto the property ladder remains a big challenge. There has been increasing support from lenders, including more flexible affordability checks and a growing range of low deposit options, something I've written about in previous LinkedIn newsletters. There is also a section on first-time buyers in my most recent LinkedIn newsletter that you want to check out. And she goes on to say that looking ahead, borrowing costs and consumer confidence are likely to continue shaping activity in the coming months. House prices are expected to remain broadly stable, while interest rates stay slightly elevated. The housing market remains closely tied to wider global developments, with a return to a sustained house price growth depending on an improvement in inflation outlook and a fall in mortgage costs. So a lot of similar headlines coming across from the different house price indexes, and just going to be running through the last few in a second. Right, where are we? So eServe, just zoom in on that bit. So average house price in Great Britain sits at 327.5, 1.6% higher than a year ago, 0.2% over the month, and 0.4% over the quarter. Pattern remains affordability led. The lower price regions seeing stronger growth, while higher price markets such as London and the South remain under greater pressure, which I've already touched on. Wages have risen faster than house prices, improving price to earning ratios, as you saw in the nationwide summary that I just shared. However, the higher borrowing costs and household bills continue to weigh on home moving decisions, which you will see. I'm pretty sure there is a graph on this. Let me just find it. There we go. So affordability has improved, but only up to a point, as you see there. So wages have outpaced both CPI and house price growth over the past couple of years, improving some headline affordability measures. Earnings have risen compared to house prices. The improvement only tells part of the story, though. Many regular household costs remain significantly higher than a couple of years ago, with some rising faster than overall inflation. So for buyers and movers, stronger earning growth does not automatically translate into greater buying power. You've got high mortgage costs, the deposit requirements, transaction costs are at record highs, and you've got the wider pressure on their disposable income as well. That's going to continue to weigh on affordability and buyer confidence. So just making sure you let sellers know the buyers are out there, they're wanting to transact, but they're very cost conscious and they're shopping for value. Worth noting that. So, outlook, wages have outpaced CPI, household incomes have not fallen in real terms overall, weekly earnings have risen compared to CPI and house prices, but even so, many regular costs are still much higher than they were a couple of years ago, and higher mortgage costs mean the improvement in headline affordability may not fully be felt by buyers. Improvement in wage to house price measures only tells part of the story. Inflation over the same period, and then some regular household costs have risen faster. So whilst wages have outpaced CPI, household incomes have not fallen in real terms overall, but many regular costs are still much higher than they were a couple of years ago, which will affect the buyer confidence. So for buyers and movers, the improvement in house price earning ratios is only one part of the picture. Borrowing costs, deposits, transaction costs, the wider pressure on disposable income is continuing to be a constraint on buying power. So as a result, house prices are expected to rise year on year in the near term, but growth is likely to remain very modest. Again, it's interesting that we're seeing a very similar story from all the house price indexes. So that is eServe. Home.co.uk. So there's a few bits I could be looking at here, but the thing I want to highlight is let me just remind myself where we are. Stock levels was the thing I really wanted to touch on. So stock levels edge higher over the month, agency portfolios reaching over 500,000 unsold property. They're saying it's lower than a year ago, which is interesting. And new instructions are down sharply too. So it's only the only anomaly I would say where they're saying things are down. Supplies gradually tightening from last year's high, which alongside resilient demand helps explain why prices have continued to firm. So that's what everyone else has said. So a couple of critical insights, supply elevated, but borrowing costs no longer rising. The market has found an uneasy equilibrium. That sounds very AI. Prices are firming gently while a large overhang of unsold stock keeps sales realistic. The result is a buyer's market, but is nonetheless grinding slowly higher. So yeah, we do continue to move more into a buyer market category. The broadening of regional gains is a standout feature of this month's data. Again, lots on the regional data this month. All 11 regions posted monthly price rises, led by the more affordable markets of the North, Wales, and Scotland. And total unsold stock, this is a good image to look at. It's in my newsletter this month. So you can see during COVID, things shot down. There was not a lot of property on the market. Things have then shot back up, but they've not gone to a level that would have been seen in 07, 08, where there were no buyers, there was a crazy amount of sellers, hence why we had lots of negative equity and house prices falling off a cliff. So we've got a pretty steady flow of property on the market. It's just the seller's expectations on price initially are nowhere near matching what buyers will pay, which is why we're seeing the number of price reductions that are happening. Um, don't think there's anything else to touch on there. We will read through actually expert commentary. So 6 months ago, the market was braced for a difficult year. Mortgage rates were elevated, stock was piling up on agents' books, and many commentators saw a real risk of a broad price correction. That correction has not arrived. Instead, the market has absorbed higher cost of borrowing with surprising composure. I think I said that for several months for higher interest rates. We saw it in the 22-23 environment. Prices dropped back a little bit, but it was transaction levels that slowed down a little bit, and we're seeing that again. So key change is stability. Bank of England has held the base rate at 3.75% since December, which is really, really positive to see despite everything else going on outside. Fixed mortgage rates have now settled in the 5.5% region, maybe getting a little bit lower. The gap between 2 and 5 year deals has actually all but vanished, which shows it's more the short-term uncertainty from lenders pricing in their mortgages. And the number of people going into 2 year fixes rather than 5 year fixes has increased significantly. Therefore, it shows that people think that the interest rate environment will be okay in a couple of years' time. Worth noting. So predictionally, even at a high level, buyers can plan around and transaction volumes remain a bit below last year, but they have steadied after the softer spring due to the Middle East conflict. So crucially, recovery in pricing is broad rather than narrow. Every region recorded monthly gain and annual growth is now positive almost everywhere, led by the more affordable markets that we've touched on, Wales, Scotland, and the North. London has dragged the national average down for the best part of 2 years, but has finally stopped falling. A market rising on a broad front is a healthier one for the market, propped up by a single region. It's a really good line there. So they are caveats. Stock remains high, which will continue to cap how far and how fast prices can actually rise. And sellers who over reach on price still find their homes lingering. As I said, nearly 110,000 price reductions, which is the highest number I've seen at the data I look at. Inflation adjusted terms mean asking prices are still slipping down 2.2% on the year. And nominal resilience is not the same as real growth. The bank's own caution over energy driven inflation later in the year means a rate rise cannot be ruled out. I think that at the time of recording, they're anticipating one rate rise this year to 4%. They were in the height of the conflict, maybe thinking there might be a few. But I think the way that they've spoken in the press has meant that that will do the talking for them, and we shouldn't be too far off 3.75%, 4%. But those thoughts of getting cut closer to 3% by the end of the year are obviously firmly out the window now, but that was before the conflict started. So, um, on balance, the picture is one of a market that has found its feet. So fresh, barring a fresh shock. Obviously, we're never too far away from black swan events now. We tend to have a instant shock to it, but and then recover a lot better now. But they are expecting modest single-digit annual house price growth at home.co.uk to persist through the second half year, with the regional pattern, affordable areas leading the way, and then the capital lagging behind. So, in conclusion, after a long period of going sideways, UK property market is edging higher on a broad front. With borrowing costs stable and demand resilient, the balance of risk has shifted from correction towards steady, which is a nice place to be. And if unspectacular, growth provided the rate environment holds. And then lastly, UK house price index. So this is completions in April, which I touched on earlier, would have been sales agreed at the back end of last year. The average UK house price sits at 270,000, monthly increase of 0.7%, and then annually sitting at 3.8%. And to go to Land Registry, let's just refresh the screen, hopefully. Let's try and refresh that again. Where are we? So April 25, 260, April 26, 270. And I'm actually going to take this back now to start of 2020, just before COVID. So if we look at the peak of the market here before the mini budget kicked off, so around 265,000, as you saw here, a little bit of a drop off to the mid 250s, and then things improved again, dropped off a little bit, and then they've improved. So you get a bit of a short-term uncertainty with pricing and transaction levels, but as history keeps showing us, things normally tend to get back as the market is very resilient. So that has been my H1 2026 UK property market update. I hope you have enjoyed watching it. Again, like I said earlier, make sure you like, subscribe, follow to the channel, go to LinkedIn, subscribe to my newsletter so you get it into your emails every month. If you've got any questions on anything I've discussed, or if there's anything you want me to include, exclude in future editions, do let me know. I will be back early in August to be reporting on the July data, year to date, and how July compared to June. And until then, take care and see you next month.